So I'm looking for growth anywhere. And the high level thesis of that growth was what we believe that it's going to come from technology. Like that's clearly, growth is a clear segment there, and that's going to lead the way. But the other side of that too is that you can get so technophiled, if for lack of a better term, that you have these blinders on about all of this innovation, about all of this George Jetson space travel stuff, and without thinking cognizantly through the value chain and saying, wait a minute, where does the stuff come from for this wonderful, beautiful future, right? And that kind of and that's where we say, listen, you kind of need to own the whole stack.
Think. Act. And prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show, where we think, act, and prosper. This channel focuses on changing financial trajectories and building legacies. And today we have a special guest, Thomas George, coming on to the show for the first time. He is a fund manager and he has been in the game for a while. He actually was the commodities trader at TD Ameritrade. And so we're going to have him on the channel, get his view on the markets, get his view on commodities. And he's also interested in some other sectors that we don't talk about a whole lot. But you know that when I bring it up, it means that it's pretty bullish. So without further ado, let's get to the interview. Hey, Thomas, I'm glad to have you on the show today.
Great to be here. Thanks, Dale, for the invite.
Yes. So it seems like you have the curse of two first names.
Right.
My name's Daryl Thomas, and then your first name's Thomas, so I have two first names too.
Yeah, right. It's you know what? You just answer to anything, man. I just just like, let's go. It's
Yep. I got you. So it's been really cool just following you on Twitter and everything, or X, and you bring a really solid perspective. Like, I've been seeing you very bullish on commodities, but then you're also in the tech sector too. And I think I've heard you tweet about crypto a little bit too, or Bitcoin at least. And so what's your investment mindset in terms of balancing out, these different types of investments that you tend to get people in one camp or the other camp, and people miss a lot of growth. I was texting some friends of mine, and we're all investors in precious metals and gold stocks and things of that nature. I was texting them and I said, hey, I got to get some growth from somewhere while gold tries to put on his icy hot and get his hips warmed up and to get moving. Right? I got to get some money somewhere,
Yeah.
And so, but I noticed that you do that. And so could you speak to more of that?
Yeah, well, so yeah, you put it right. The commodity trade can be a tough one. It can be the best of times and the toughest of times. And the tough times are really just waiting it through, right? You know that there's value, and you're solidified in the thesis and holding it through, right? But I think so what we advocate, and this is our strategy in the DARP ETF, is basically a barbell strategy it's a growth ETF. Straight up, it's a growth ETF. So I'm looking for growth anywhere. And the high level thesis of that growth was what we believe that it's going to come from technology. Like that's clearly, growth is a clear segment there, and that's going to lead the way. But the other side of that too is that you can get so technophiled, for lack of a better term, that you have these blinders on about all of this innovation, about all of this George Jetson space travel stuff, and without thinking cognizantly through the value chain and saying, wait a minute, where does the stuff come from for this wonderful, beautiful future, right? And that kind of and that's where we say, listen, you kind of need to own the whole stack. For us, there's nothing greater than AI in terms of true disruption. And the DARP the DARP ETF stands for disruption at a reasonable price. So, at a reasonable price, right? And so for us, we do believe that AI, and we're large holders of NVIDIA, we believe that, there's real value there when you look at it on a 3 to 5 year time horizon. And just hearing what Jensen was saying and just the blue sky that's available there, and the way it's impacting all our lives. Like, I don't know anyone that hasn't been touched by AI or been AI curious and gone down the rabbit hole a little bit, right? But the other side of that is that you're seeing the EV revolution. You're seeing all of these sorts of what I'd call visions of the future, but you're not really backing into how those commodities are going to get produced to meet that, right? And so for us, that's really the opportunity. And that's where we see, like, really you get real value and that structural growth, which is kind of the best of both worlds. And that's what we see on the commodity side. And then, that covers off all the, what I call the battery metal side. We're super big bulls on natural gas as well. And so I posted a graph recently, which I can't emphasize enough. So we're bullish on natural gas as the transition fuel to the future, plus obviously uranium, nuclear is clearly important, and then all the suite of battery metals from nickel, lithium, copper's the top, right? All of those, bullish all of those, right? But the thing about it is we don't invest in the commodity, we're investing in the equities, right? And let me give you an example. I posted on Twitter just from the top of my mind, right? So 1 year returns, right? Like, if you just polled anyone on the street, right, and said, "What? Oh boy, isn't natural gas in the dumps?" You're like, "Yeah, that. Who would ever invest in natural gas?" Right, and that you aren't wrong in the actual commodity itself. But if you looked at our two holdings, right, and so when we look at, like, say, a Range Resources, that's up nearly 40% in 1 year, right? And then in the flip side of that, if you were to look at the natural gas, the ETF, the physical ETF, I'm actually just going to pull up the performance because I just want to get the numbers right, because you may as well just do it right. But I think this is important, right? So if you look at it, Range Resources, it's up 42% in a 1 year, and then EQT, it's up 24% 1 year. These are natural gas players, right? Now, if you compare that to the UNG, which is the natural gas futures ETF, that thing is down 42%, right? It's crazy because it's investing in the futures, and you're getting negative roll. Like, there are mechanisms there that hit you more than the actual commodity going down. Natural gas is down 14%, and this ETF is down 43%, but it gets worse than that. Like, a lot of speculators are like, well, let me double up and go double X on this thing. And so the what's it called, the Boyle ETF, that thing is down 80% in 1 year. So it's crazy. Like, this stuff is so, like, but the flip side of it is the companies that are producing it have had actually very good returns in a backdrop of the S&P 500 being up 24%. So, you have Range Resources, clearly greatly outperforming that. So I think that, of course, there's a lot of waiting in on the mining side, and I think the gold side's still yet to come. But the getting paid to wait, and we write about it in our Substack, that one clear strategy you can use with a certain subset of resource stocks is focusing on shareholder dividend yield, total yield, to get these type of returns, right? We focused on dividend yields. Now, share buybacks are obviously becoming an important component of the way cash flowing commodities producers can give back capital to shareholders.
Mm-hmm. Gotcha. Yeah, because that's been a place that I've been investing in, is getting some type of dividend on my yield, or getting some type of yield on my investment while I am waiting this thing out, And so I want to get your take on oil, because oil, like, we're seeing, like, Diamondback Energy just did an acquisition. We had Exxon do an acquisition, Chevron, you got Warren Buffett buying oil. And so this commodity seems like there's some big money, like, these acquisitions they're doing are billions of dollars. And, I'm just kind of wondering what's the outlook for that moving forward, and if that's something that you all look into as a commodity. Time out. Quick break in the action. This message is brought to you by the Rule Symposium. This annual symposium is hosted by the legendary investor Rick Rule himself. It will take place from July 7th through 11th in Boca Raton, Florida. Mr. Rule invites some of the most brilliant minds in macroeconomics and natural resource investing. This year, featured speakers include Danielle DiMartino Booth, Nomi Prinz, Jim Rickards, Grant Williams, Lobo Tigre, and more. Rick even organizes the Living Legends panel, where he invites individuals who have built billion-dollar businesses from scratch. Attendees will be introduced to a myriad of companies active in the natural resources space, with the companies invited being the ones that Rick Rule invests in himself. The symposium is held at the Boca Raton, which is an amazing resort with exceptional amenities. I attended in 2023 and thoroughly enjoyed my time there. I went on an amazing cruise with Rick and other investors and CEOs of companies, and even had the opportunity to test drive an Aston Martin for the first time. So don't miss out on this opportunity to have fun and receive high quality education to help secure your financial future. Click the link below to sign up, and I promise you won't regret it. But if you do, Rick offers an amazing money back guarantee. So what are you waiting for? Click the link below to sign up today. Now, without further ado, let's get back to the content.
Yeah. So we structurally, like oil, like, we're long it. We're way more long natural gas. Like, structurally, we believe that when you look out 10 years from now, I'm going to get a very clear picture that we're going to use a lot more natural gas. And I think that's an exciting place to be. We can quibble about the price, but I'm pretty certain about the volume. With oil, you have the flip side of that, where I think the volume side of that, when someone to say 10 years out, we're pretty certain that it's going to be higher, and just like the way it's always grown. But there's a vocal component saying, well, what if EVs were 30% or 40%? Like, then your math gets a little fuzzy, right? Like, that's fair to say, right? But so I think that's always this looming, cloud. We don't think it's a real issue. So when I think of these big guys buying stakes in these companies, it's almost a bet that the prices with a 7 handle on oil is a very attractive price. And as you know, with all the built-in inflation, all of that coming through, it costs a lot more to pull these commodities out of the ground. So there's no question you're seeing a clear smart money component of the market saying, I'm not looking for three baggers they're like Chevron. These are big companies, right? But they're saying, listen, these companies can have attractive returns in excess of their cost of capital. And if you look at like the way Buffett really built his business, these weren't like super speculative small stocks. He just found those stocks that literally were exceeding their cost of capital in a meaningful way, right? And that's really how you build shareholder value, right? It's not exactly what's sexy on the shelf, like for the here and now for most investors, but that's how you really build wealth, right? And I think that, like, for commodity investors, when you see big investors who do their homework, putting the flag in their ground and saying, hey, here's where we are. Just to add a voice to that, Jeremy Grantham from GMO, who's I've been a long time reader. He's one of the great resource. I'd say one of the most astute resource bulls. He made a comment at the exchange ETF conference saying, listen, this is one of the most, like, when you look globally, right, talking about valuations, be it international stocks, US equities, Mag 7 across the world, Indian equities, you're not seeing screaming value, right? Like, there are pockets, like China is cheap, but like, everyone's got questions there, so no one's stepping in a meaningful way to, listen, I'm going to go hand over fist buying China. Like, so, anywhere that it's super cheap, there's real questions around it. But he goes, one area that the cheap commodities have been taken out of the ground already, so prices are going to go up. B, the stocks themselves have been hammered, right? So you have this whole basket of stocks that are cheap, and then B, on a valuation perspective, they're cheap. So you kind of have a great trifecta of the tailwind of strong commodity prices plus valuations are very attractive. And that itself right now is very hard to find in the market, right? And so with commodities, like you always got to eat the volatility, right? That's the hard part.
Yeah, we're seeing that with uranium right now, right?
Yeah. Yeah. 100%.
Big pullback, and so with uranium, for example, so
Yeah.
you're bullish on uranium.
Yeah.
The outlook hasn't changed, but the recent pullback may have shaken out some investors. And so are you currently just staying put with your investments in uranium, or are you actively looking at some that you may add to the pile that you already have?
Yeah, so since we've added our uranium positions, we've never taken it off, right? So we obviously always try to like advantageously add to our positions, but and when we see pullbacks, my partner Scott Willis, he put out this great graph saying Cameco, he just looked at the drawdowns in Cameco all the way through the last real big bull run, right? And so every year in Cameco, this is just an example, right? Every year in Cameco, in that last bull run, you had a pullback of 40 to 50%, right? So structurally, like that's crazy, right? Like if you're not getting shook there, like like the amount of diamond hands, like you gotta have chiseled hands to wear this thing, right? So and I'm just telling you, like I'm a bigger man after investing in uranium by a country mile. There's nothing that can really, I can have hammers flying beside me, whatever, right? It's like, so that I think is a backdrop of what a uranium investor, the fortitude. And if you look at the different commodity camps on Twitter, there is no camp more hardened, no camp than uranium Twitter. None, right? Like these guys, if a bear wants to come out, we maul the bear. We take the bear down. They literally leave Twitter. They go start Substacks. They're gone. They lock their account. That's that's what uranium Twitter does. Like they body bag people, right? But because it's a hardened group, right? And so of course you're going to get these pullbacks. And I think the real strength of the thesis is obviously a macro thesis. Cuppy has spoke about it, on length and eloquently, and really presented it well. And there's a host of other great uranium analysts who've done the same, right? And so I think everyone's on the same page. And I think when you look at these types of pullbacks, if you have the opportunity to deploy capital, obviously the opportunity, but the other side is just keeping the picture in focus. And we've been working on a big piece of, we're about to, we've had it kind of just in the kitchen, so to speak, right? And but I think it's going to put into perspective just the opportunity that presents in front of us. I put out a little short video on Twitter saying, listen, the Cameco trade, that's like a very institutional trade, like a lot of big funds, etc. Like, okay, you want to own uranium? Yeah, throw it here, right? But you're getting to that pinch point for even a Cameco where things aren't like, it's going to be a tough slog for Cameco going forward, right? They're going to have a hard time bringing pounds to the market. It's going to be more challenging for them to be viewed as a growth story outside of price, right? And so we think price will do its thing. And the other side of it is, well, then if the opportunity is still wide open, blue sky, that you get the small cap season, you get this opportunity where small caps really step in. And that's really what's happened the last bull market. And we believe it will happen this bull market as well. For one simple reason: if the issue is getting pounds to market, you got to go get pounds. Like there isn't this magic thing where this cohort of stocks just get, the price goes to what, 200 or whatever, right? And these stocks just get orphaned forever. Like that's not going to happen. Obviously there are aspects that are different this time, but at the same time, I think retail hands are much stronger now. Like the knowledge in retail is bigger, but at the same time, the last bull market, you would have had a lot more commodity focused funds that would have been there too. But I think the market's evolve, and at the same time, in commodities, price cures everything. Can't emphasize that enough, right? If your stock's ailing, if your subsector's ailing, the fastest fix to that is price.
Yeah, for sure. And so I do want to transition because you mentioned like the big institutions going into the top, the more bigger cap stocks, Cameco, Kazatomprom, and such. I mean, you are in them, the ETF and such, and then the small caps haven't ran yet. So it kind of reminds me of like the cryptocurrency bull markets. I mean, right now you have the Bitcoin spot ETF get approved. You got massive amounts of funds and money flowing into those. I mean, Ethereum's been running, and then you have these altcoins, that can go parabolic at any point. And so I'm just kind of thinking that's kind of like how I've been thinking about it as well. And so, are you into the crypto space? I mean, it's obviously part of the tech sector, technology, blockchain technology, and such. And then now you have the Web3 development and such. And so, what are you looking at there?
Yeah, so we're outside of, so the only names we're really looking at are names that have leverage to Bitcoin, nothing else, right? So we think that Bitcoin itself, there is a real valid case for digital gold. The uptake on the ETFs has been nothing short of extraordinary. North of 4 billion has come into these ETFs. When we were putting out our thesis on this prior to the ETFs launching, we said, listen, this is going to be pretty epic for one key reason, right? You're getting all of these ETF providers, big companies, right? All on the same hymn book, going to market and saying, boom, store of wealth asset class, right? And that, that marketing strength, as only, American capital markets can do, is a thing to behold. It really is. And that, in literally just over a month, we got $4 billion. We, at the end of the year, there were ranges of between 10 billion on like the average end and maybe 14 billion on the high end for the total year. We're going to eclipse that like literally in 2 months. So this is like, and Grizzle came out and said, listen, the number is going to be closer to 50. And like, lo and behold, the number's literally going to be closer to 50. And the way that works is the weight of money that comes in will push it's such a tight market that will push Bitcoin higher. So we play it through the miners and other associated stocks, but all with a relation to Bitcoin. So we really don't believe the rest of the ecosystem has proven itself yet. And that's important, right? For us, you've had like more than a decade here. Like, why don't we have anything? Like literally, like, why don't we have anything? And here's where I'll put the real test, right? And again, this is all ex Bitcoin, right? If crypto really mattered, why is like when you think about how something really seeps into a population, right? I got my son using ChatGPT, right? So I can say genuinely, right? I can point to many people that I know that are interacting with AI in some shape or form. That to me is genuine disruption. Whatever's happening in altcoin, shitcoin world, that to me is Ponzi, right? At some point, you got to call it for what it is, right? Like, no one is actually producing anything of value. No one's actually using it other than just this like forever pump. All fine, well and good, but like, come on. Like, and I think, but to your point, I think the cascade is correct, right? You have a genuine population set that is crypto native, that's view Bitcoin as like the first one to run, and then all of these other altcoins run behind. And that absolutely does, that happens. But my view is that unless these things that actually produce anything of value, unlike junior uranium miners or junior gold miners, the list goes on, junior nickel miners, they will produce something the world will need. Then it's like a self-reinforcing rug, right? And that kind of, that's the core difference, right? Like I feel like I have a lot more confidence, I'll feel like I absolutely know that I have a lot more confidence in a company that has a resource that's defined. I'm a shareholder. There's no question that I have a stake in this, in this project and this mineral, right? That's under the ground. With crypto, when you get down to the altcoins, just like, you don't know what you got.
Yeah, definitely. You don't know, like, that could be information that's hidden and all
Yep.
types of stuff. I mean, which we've seen that before. And and with that though, like even with the uranium and the miners, you do have these like junior, resource stocks or explorations, that don't really produce or find anything, you know what I'm saying? So you do have that kind of caveat. And so
Oh,
you
for
have to
sure.
do your due diligence. Like it's real. And so this transitions to like another segue, because you mentioned that we're in the era of stock picking,
Yeah.
and you can't just throw a dart at the board. Like you have to, or you can't just buy an index and just expect it to just perform well. And so what are some of your thoughts on that? And then also what are some things that, average retail investors can do to weather these storms and to be more diligent about what they pick?
Yeah, it's a great question. I think that really gets to the crux of the matter, right? The reality about where we sit right now, I think we are definitively in a stock picking era. And when I think about indexation, especially with speculative asset classes, well, you're just now diversifying myself in a lot of companies that a lot of them won't make it across the line, right? Like, as you know, right? I think stock picking, especially in areas with high torque, high volatility, where leadership matters, I think that's where active management really comes in, right? And I think you first of all got to do your due diligence on the company, the quality of the assets. Like there's a laundry list of, you know, checklist of what you got to look for. The other side of that too is that accept that this is a speculative asset class and that you have to, even within your own shortlisted group, you still have to diversify among that depending on how low market cap you're going, right? Now, as you get bigger market cap, you can take bigger weights, right? Like I can have a 16% weight in NVIDIA because it's producing tons of free cash flow, right? I think that's kind of the inverse, right? Of, if you have a company that's throwing off a ton of free cash flow, well, that should, correlate with how big your position is. Like there's no question. That's how, now will we take higher speculative positions? Absolutely. But with our view that, there's a thinking that, listen, we know the resource is real. We know the partners are real. Whenever I see like big mining companies that are shareholders, that to me gives me a lot of confidence that, there's something real and tangible here. But beyond that, you got to do the due diligence on the resource, understanding the quality of it, the management team. Can they build this out? Can they prove out the resource? But more than anything, right? I think the bigger picture is not to get over your skis with respect to position sizing as it relates to a certain number of names that you have, right? And I think that's that's the part about the volatility of your portfolio, right? And it's, we try to risk weight everything. We'll get it right, we'll get it wrong. But it's through time, I think we've really figured out there's an art to this. Absolutely. There's the raw numbers of how volatile your portfolio is, but the other side of that is you actually understand what the operations of these businesses are. And if that's really the opportunity, right? If you can handicap this to say, listen, the market's pricing it for 2x volatility, but I think that it's actually a 5x return kind of thing, right? And so, if you, those are the opportunities that you have to kind of seek out.
Yeah, definitely. And so I've been sharing this with my audience, like I think it was 2022, the end of 2022, beginning of last year, 2023, within that time frame, I got too bearish. I was way too bearish. I mean, I saw NVIDIA, $100 some, Meta, $90,
Yeah.
right? And I was just getting too bearish. It's gonna go down further. It's gonna go down further. I don't want to catch a falling knife. all of these things. And I began to get too much into that bear depression, that camp.
Sounds like you've been reading a lot of Zero Hedge.
Yeah, yeah.
No,
So
listen, those guys are great. Like but it's easy to get caught in a, in a, the, I'll just say something. One of the easiest hacks on social media, easy hack on if you're running a podcast, whatever, is just to be a bear. Like, just to say, listen, the end of the world is soon. I'm just going to interview a bunch of people that, and then you just become this doom kind of like, but it sells though. It absolutely sells, but it goes against what the market's delivered for the last 100 years, right?
yeah, yeah. It's really like, it's like the psychology of bad news. Like, people
Yes.
tend to gravitate more towards the bad news versus like anything, a positive, story that may come out. Like, someone's like, oh yeah, that's cute. But
Yeah.
then they're not really actively seeking that. Most people are like addicted to like the bad news, which, with the bear situation. I mean, I study a lot of macro, and
Yeah.
and I'm thinking through this, and obviously it comes down to like time frames and things of that nature. I mean, because you could have a big crash, but it may not be for another 10 years or something.
Yeah.
Like, who
Like,
knows,
well, I think that's like truly is what it comes down to, right? If you spend a good amount of your time thinking about like the end of the world, and like I'm talking the bear case of like a Bitcoiner or a gold bug, like you know what I'm talking about. If you kind of let 20 or 30% of your mind space take that, and listen, I've been there, right? I can guarantee you I'm not going to outperform the market. Like, I can guarantee you, because I'm always just worried. I'm like, oh, that's the tipping point, right? I got to take this 20 to 50, or I'm going to go into whatever, right? But I genuinely believe that, throwing away all the, the macro noise for a second, right? That people do great things. The market with great companies goes up. Obviously there will be trying times, but I think through time, you had this great tailwind of American ingenuity. Like, and that engine is so damn good. So like, maybe talking about one point about that. So we actually did put the flag in the ground. We got in we put in our position on Facebook a bit more. It just kept going down, right? Like, we lived through this. We're like, listen, this stock is cheap. And the one thing, a big part about that was that we thought, full stop, Zuck is like one of the greatest tech leaders on the world. He's literally doing like a highlight reel right now, in terms of showcasing how this guy is just that good. But the flip side of that is just, this is why valuation and looking at like going under the hood of a company. When we looked at the free cash flow, we said, okay, so I was sitting with Scott and I said, take away this, like take away Instagram, assume that goes to TikTok, you know what I mean? Kind of thing, right? You have to do this. Like, what's a absolute worst case scenario, right? Because there were all these tailwinds, like assuming this metaverse that he was building. Thank God he like abandoned that stupid idea, right? So like, there were a lot of negative things on the horizon, but I think if we actually put it into perspective, it was actually an attractive time. I think when you looked at the free cash flow that even the base part of the business could have done, it was a double-digit mid-teens free cash flow, and that to us was like, that just seemed like way too over the top, and again, that was a super bear case, and so that's the type of analysis that you need to do when the market whipsaws you to ground yourself. But that can only really be done using fundamental analysis.
Yeah, exactly. Yeah, because I mean, I had the same thing with Netflix too. It's insult to injury. But
Yeah.
so Thomas, where can people find more about what you do and everything? I know we're running short on time. Love to have you back on. But
Yeah.
where can people find more about your work?
Yeah, so we have a Substack, Grizzle Research it's grizzleresearch.substack.com. That that's we publish all our stuff there. We have a great macro strategist, Chris Wood, my partner Scott Willis, myself. We always we funnel our thoughts through there. We have our meteor pieces. So it's research and quant is the Grizzle Research and Quant is the product there, and it's there's a free component, and then there's like if you want the deeper analysis, there's that. And then also I live on Twitter at @ThomasG_Grizzle. We also we're on YouTube as well, but that like that kind of broad scape is that's our the key areas we are. And the ETF is ETF.grizzle.com. And that's the DARP ETF, disruption at a reasonable price.
All right, sounds good. Appreciate you coming on, bro.
Daryl, thank you, brother. I look forward to coming back again, man.
Yes,
lots to chomp on, man. I'll bring some charts next time. I'll bring some charts.
Let's do it. All right, take care.
Thanks, man.